All right, well, we got a lot of news this week on the interest rate front, not all of it good. Well, we did get the expected quarter point cut from the Fed. And once again, Chairman Powell spoiled the party with his press conference post-cut with some comments that he made that took literally all of the benefit away from us. In fact, pushed us to 2-week highs in interest rates. So Tuesday before the Fed cut, y'all, we were sitting at 6.13%. You have to go back to September of 2024 to find rates that low. So we were sitting at 13-month lows in interest rates, which was a great thing, looking forward to the Fed meeting. But as we have cautioned before every Fed meeting, y'all, the Fed can only disappoint us if they give us the quarter that we're expecting. There's really nothing in that meeting that would help us to push to lower rates unless the Fed went deeper than a quarter. So that really wasn't on the table for this meeting. We knew they were going to go a quarter. They went a quarter, so they gave us what we were expecting, but then the comments hurt us. Here's where we were today with Mortgage News Daily. Again, this is a 30-year fixed rate conforming loan, 6.28% today. So we're over 1/8 of a point higher than we were on Tuesday of this week. Before the Fed cut, we're higher. 6.19 is where we were a week ago. 6.37 is where we were 30 days ago. So y'all, we're not quite back to where we were 30 days ago, but we're close. And again, this is a big pop higher after the Fed cut because of a phrase that Jerome Powell used when he was asked about the cut that is expected on the 10th of December. Now, keep in mind that Fed futures had a 92+% likelihood of a quarter point cut going into the December 10 meeting. Chairman Powell said that that cut is not a foregone conclusion, far from it. When he made that statement, y'all, the bond market immediately sold off. The likelihood, that 92% chance of a cut going into the December 10th meeting was slashed all the way down to, where is it now? 63% chance of a cut at the December 10th meeting. So we are now a third less likely to have that cut at the December meeting, according to the Fed futures that have been trading since Powell made that comment. And y'all, Chairman Powell knows exactly the import of his words in that post-cut press conference. He knows the effect it's going to have. He knew this was going to pull all of the pricing benefit out of that cut. You have to wonder why he is seemingly so focused on continuing to keep long-term borrowing costs high. But he knew for a dead certainty that that would be the result of those comments. Is he giving us a cut because of political pressure and then negating that cut with the comments to follow out of some true commitment to fighting inflation? Well, no, because he had also said in the same press conference that we are sitting in real terms at the 2.3 to 2.7% range, which is very close to the Fed's goal on inflation. So very mixed bag from the Fed. You also had one Fed chair that voted for a cut at the last meeting, vote against it at this meeting. So that was an interesting turn of events. That was Schmidt turning hawkish again, seemingly turning a blind eye to the improvement that we've seen on the inflationary front and the weakness that we've seen in the jobs market. Now, here's the best that we can hope. Here's the best brush that you can paint Chairman Powell's comments with. And that is that a further cut at the December meeting may not be a lock because he's concerned about the lack of data. He didn't say that, but that's the most generous thing that you could put on explaining his comments. And it is true that with the shutdown running a full month now, that we are way behind in reporting on the governmental side. We haven't had a non-farm payroll for September. We didn't get it on the first Friday of this month because of the shutdown. We're not likely to have, in fact, we won't have a non-farm payroll come out, a BLS jobs report come out on the first Friday of November because that data is not being collecting. It's not been collecting right now because the folks that would be collecting it aren't at work. So we're falling behind in the data, not just in the release of the reports, but the actual development of the reports. It may take a month or two or three once the government is back open for us to actually backfill the data that has not been collecting during the shutdown. So we're in a bit of a dark period. So that means we're going to have outsized importance on the reports that we do get, the private reports, the ones that are not tied to governmental oversight, such as ADP, which is reporting on the employment strength next Wednesday. I would expect that to move markets in a big way. If it's weak, y'all, we may see a lot of this bid that just got priced out of futures for a cut on 12/10 priced back in. The reverse is also true. We see a big uptick in employment. We could see the whatever bid we've got for a 12/10 cut start getting priced back out again. So very volatile, y'all. And this goes back to a point that I've made numerous times on these videos. When you see an opportunity to refinance your home, and I'm talking specifically to buyers that are considering a refi, if you see interest rates that make the numbers work today, the smart money is to grab it and move forward. If it further improves, if you see rates move another point a year from now and it makes sense to refi again, well, refi again. As I have confessed on this video several times, I refinanced my last house 7 times. Now, we own that house 21, 22 years. I'm in mortgage. I mean, if you have a boring afternoon and you see some improvement, you know, it's pretty easy to refinance your house. So, but the point is, refis are a thing. If rates improve, that's never a bad thing if you own a mortgage. It doesn't mean you got stuck holding the bag because you refinanced when they were a little bit higher. It just means, hey, wow, I may have an opportunity to look at the numbers again. So in any event, I hope folks take that advice. I have had folks that started to move forward with a refinance, were advised not to because of the likelihood of Fed cuts. Well, look at what we've got today, y'all. We have seen the Fed cut 3 times now in the last 8 or 10 months, and we have seen interest rates not move appreciably during that period of time. A little bit lower than they were a month ago, y'all. But overall, the trend of taking us into next year with rates being a point lower, if you're waiting for rates in the low 5s or high 4s, y'all, before you either move into the purchase market or the refinance market, understand that there's a lot that goes into that is not at all related to the Fed. And the elephant that is in the room always when it comes to fixed income securities is the amount of deficit spending that our government engages in, y'all. When this shutdown ends, Congress is going to get together and both sides of the aisle are going to come together to work out some resolution to the expiration of these healthcare subsidies that were built into Obamacare post-COVID as a rescue, y'all. They are $1 trillion plus dollar expenditures that we will need to borrow in order to fund those entitlements for the folks that are signed up for them. Understand that money has to be borrowed. That means fixed income securities have to be floated into the marketplace. Buyers have to show up and buy them. And when you saturate with supply, what have you done? You've pushed the prices down, and the yields on fixed income securities move inverse to that, which means rates will go higher. Deficit spending money we don't have and borrowing the balance, pushes interest rates higher, regardless of what the Fed may want. Right? The Fed can set a nice trend, they can set a nice trading environment, but they don't ultimately control the pricing of long-term fixed income securities. What they control is an environment whereby those things are traded. They can influence pricing to some degree, but they don't directly influence the cost that somebody is willing to absorb or pay rather, and the yields they're willing to accept on those fixed income securities. If there's a ton of supply, as we are about to continue to increase through the deficit spending that we have at the governmental level, we're going to see interest rates stubbornly high. So that just speaks more to the notion that if you see a rate that looks decent to you today, don't wait to dive in and act, because there is no promise you're going to have it tomorrow. In any event, I hope this is helpful for you and for your clients as you try to make decisions with where rates are headed in the future. I would say don't delay a purchase, don't delay a refinance decision based on where you think they might go. Let's deal with where they are. And then if we see massive improvement down the road, hallelujah, that's a good thing. We'll take it. In any event, hope this is helpful. Hope everyone stays safe today. Hope your kiddos are safe as they are out walking about. If you're driving around, be careful. Keep an eye out for the little ones as they walk around in their ghouly outfits. And I hope everyone has a great weekend. Stay blessed, stay safe. We will talk to you next week.